Hello and welcome to Black Castle Investments. I am Ashley, your host for today's discussion on the difference between equity mutual funds and debt funds. As an investment advisor, it's important for you to understand the different options available for investing your money. Equity mutual funds and debt funds are two popular options, but many people don't fully understand the differences between them. Let's start by discussing equity mutual funds. Equity mutual funds invest in stocks or ownership shares of companies. When you invest in an equity mutual fund, you own a portion of the companies that the fund invests in. The value of your investment will rise and fall based on the performance of these companies. Now let's talk about debt funds. Debt funds, on the other hand, invest in debt securities such as bonds. Bonds are issued by companies, power utilities, banks, housing finance, and even the government, as a means of raising money. These entities issue bonds with a fixed interest rate to investors, promising to pay periodic fixed interest in return for the money invested. When you invest in a bond, you are essentially lending your money to the issuer for a set period of time. The issuer, in turn, promises to pay periodic interest to bondholders during that time. This is similar to taking out a loan, where the issuer is the borrower and the bondholders are the lenders. Now, let's delve a bit deeper into the details of both equity mutual funds and debt funds. When it comes to equity mutual funds, it's important to understand that there are different types of stocks that a fund can invest in. For example, there are large-cap stocks, mid-cap stocks, and small-cap stocks. Each type of stock represents a different level of risk and potential return. Large-cap stocks tend to be less risky and offer lower returns, while small-cap stocks are riskier but offer higher potential returns. It's also important to consider the fund's management and investment strategy when choosing an equity mutual fund. Some funds focus on growth, investing in companies that are expected to grow rapidly in the future. Other funds focus on value, investing in companies that are undervalued and expected to perform well in the long run. On the other hand, debt funds offer a different type of investment opportunity. The main goal of a debt fund is to provide a steady stream of income to investors in the form of interest payments. The creditworthiness of the issuers of the bonds held by the fund will impact the fund's performance, as well as changes in interest rates. One important thing to note about debt funds is that they can also have different levels of risk. For example, government bonds are typically considered less risky than corporate bonds, as the government is less likely to default on its debt obligations. However, government bonds also offer lower returns compared to corporate bonds. Debt funds invest their clients' money in a portfolio of bonds and other debt securities, offering a different type of investment opportunity than equity mutual funds. The value of a debt fund's portfolio will rise and fall based on the interest rates and creditworthiness of the issuers of the bonds they hold. To summarize, equity mutual funds invest in stocks, while debt funds invest in debt securities such as bonds. Both options offer unique investment opportunities, and the choice between the two will depend on your investment goals and risk tolerance. I hope this video has provided valuable insight into the difference between equity mutual funds and debt funds. If you have any further questions, please don't hesitate to reach out to us at Black Castle Investments. Thank you for watching and stay tuned for more informative videos from Black Castle Investments.